Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. The equity market has been testing investors' patience over the last 12 months. The Nifty is actually down 3.5% over this last 1 year. And the midcap index is actually down 5%. If you look at the small cap index, well, even worse, it's down about 7%. So it's been a tough year, to say the least. Now, in the last several months, the market has had to, of course, grapple with many issues and challenges, including, of course, the US tariffs, the whole tariff storm, shifting US policy, and some will say perhaps, a bit of anti-India policy coming in from the United States. There are shifting geopolitical equations. We've had to deal with the Indo-Pak war. And of course, there is the issue of lackluster corporate earnings. So all of this has meant a fairly challenging last 12 months where investors have had to keep their patience, and they have kept their patience so far. Now, does the onset of the festive season and the mega GST reform, does it really mark a turning point in the fortunes of the equity market? And if yes, then do we as investors need to reassess our MF strategy, our portfolios, to be in sync with the times? Well, today we have a very special guest joining in to answer some of these slightly complex questions and to make it simple for us in terms of a 3-year mutual fund portfolio strategy. Ashish Gupta, CIO at Axis AMC, is with us. Usually we always pull in Ashish for all of these complex market issues, some of the ones that I highlighted in my opening remarks. But today, Ashish promises to simplify it all down for someone who's only looking at mutual funds in at least a 3-year horizon. Welcome to the show, Ashish.
Thank you for having me, Surabhi.
So, Ashish, you tell us. I think my opening remarks were a summary of everything we've discussed with you on our market shows in the last 12 months. How are you feeling right now? Semi-optimistic, more optimistic, less optimistic? How do you feel as we get into the festive season?
No, certainly more optimistic. I think what's happened in the last 3 to 6 months, and I know it's very difficult to kind of be constructive consistently, because the amount of news flow that we have seen, the amount of uncertainty and unpredictability that has come our way, both in India and globally, not just last 6 months, but last couple of years, has been unprecedented, right? There have been wars, tariffs. Now, recently, there's been talk of H-1B visas, etc. But I think for investors, what's important is that we should continue to look internally. I think for India, domestic growth is the primary driver of demand. And I think on that front, since beginning of the year, there have been multiple positive factors. I think since January, there has been a decisive turn in RBI policy. And as you know, for me, some of that has the monetary side, and the banking side is always kind of superimposes itself on my views. But since beginning of the year, we have had a very large infusion of liquidity. We have more than 100 basis points of rate cuts in India, and there is potentially some more that may come through in the coming months. We have seen government getting much more active in terms of spurring demand. In the budget, we saw income tax cut for the significant part of the population, and that has been topped up. The direct tax cut has now been supplemented by indirect tax cut in form of GST, right? And really 99% of items that were there in some of the highest slabs, GST has been meaningfully brought down. This is coming at a time where already in the rural economy that had been sluggish post-COVID, after 2 good monsoons, we had seen better activity in the last 6-9 months. So we were seeing already some signs of pickup in demand revival. If you, for example, see the demand for NREGA work, that is down nearly 25% last month. So you are already seeing some of that mass market demand pick up. And now if these other factors also start contributing to it, I think clearly we will expect GDP growth. We would expect corporate earnings growth in the next 6 months to kind of look much better than the last 6-9 months, where we have seen significant amount of earning downgrade. This is not to say that we don't have the headwinds of the global uncertainty, whether it is on account of tariffs or actually more importantly, the fact that next 12 months don't look great for the global economy, right? Those uncertainties will continue to weigh, but I think for us, really, domestic growth is a more important driver of the economy, and that certainly is looking up.
Yeah. You know, Ashish, I'll tell you, and these are conversations we hear around ourselves. I've definitely heard it in my friend and family circle. I'm sure you have, right? When investors look at their equity mutual funds, that part of their portfolio, most of them are static, maybe slightly lower, and then you've waited for 6 months, now 12 months. We all know that, yes, we need to remain invested, which is what investors have done, right? We've not seen massive outflows from equity funds. So that maturity is there. But investors are also now contrasting that performance with gold, with silver. Some are saying there are new asset classes like REITs, and the regulation for REITs is now getting, easier. So people are asking, should I be diversifying away from equity? Has that time come? Should I look at these other asset classes as well in a more meaningful manner? Till now, it was just buy Indian equities and that's your road to riches. So is that changing on a more structural basis?
I think I will certainly vouch for diversification. I think it is, particularly if you are investing for long periods of time, you need to have a diversified portfolio. And particularly if the asset classes, as you mentioned, are uncorrelated, right? So I think that kind of really improve the expected return of the portfolio. Of course, the question can be, should gold or silver be 5% of your portfolio, or 10% of your portfolio, or 15% of the portfolio, right? So I think those are bigger questions, but I think certainly you should have some of that in your portfolio. I think it's also a good hedge in terms of the risk from sustained currency depreciation. I like REITs as a product, both REITs and InvITs. They are good long-term cash flow generating assets. And given the fact that equities, particularly on a 3-5 year basis, have given very strong returns already, and even as I'm optimistic about equities, as I mentioned, going forward, we may not necessarily repeat the kind of returns people have seen in the last 5 years, right? So as in mutual funds,
that's a headline. That's the headline. He's the top boss who's picking all the stocks, and he's responsible for all the investments at Axis AMC. And he's being very realistic. Ashish is telling us, don't look at the hindsight. The last 5 year returns cannot be always projected in the future. We hear you loud and clear. So therefore, Ashish, it's so important to have this conversation today to reset some expectations and reset the portfolio, if at all if it's needed. Now, before we come to the big debate today on the show is consumption or capex, or should you do both? Before I come to that, let's talk about the headwinds which still exist for Indian equities. And US policy definitely seems to be that one headwind. Every time we think there is a thaw, now they're exchanging tweets and these social media messages, and now the trade deal will get done. One new missile gets fired, and the latest one is this H-1B visa issue. How do you sum it up, not just for the IT sector or IT stocks, but overall? I mean, is this a new overhang now?
So it is an overhang, but for frankly, medium to long-term investors, I don't know how much can we really invest on this basis, right? Most of these theses turn on their head within 6 months, if not sooner, right? And I'm sure you have seen the news flow where India was kind of being penalized for buying Russian oil, and now I think the focus is on other countries and European Union, etc. Right? What will happen in US elections? I think now they are 4 years away, right? So I think we cannot take any of these policies as long term. In fact, you would have seen news flow that the government expects by November they should get to some sort of trade deal with India. So I think we have to be very careful, particularly as you said, if people are looking at a 3-year investment in mutual fund, uh, make decision based on such news flow, right? So these will drive equity market reactions over the next these 6-9 months. But beyond that, continuity of these policies to me is very uncertain, because whichever way you cut it, right? We are saying that these US policies are harmful for India, but actually, if you see the real harm because of tariff is on the country itself, right? So what will happen to the U.S. economy, and because there the effective tariff rates have literally gone up from single-digit percentages to high teens. So I think as that impact comes in, they may have to rethink policies themselves. So I think we should not make long-term investing decisions based on all these news flow. I think we have to remain focused. Where do we see structural advantages? Where do we see? I think India and Indian companies have competitive advantages, and that is what will stand the test of time.
Okay, perfect. We take your point completely that we can't be, basing our investment decisions, that too 3-5 year, out investment decisions based on everyday news flow. So then how do we take a holistic view of our portfolios in this very dynamic market? And as I mentioned, that consumption versus capex debate, we dive straight into it, but after a very quick break. Back with Ashish in just a moment.
Let's talk money.
Well, welcome back. You're with us on Let's Talk Money. And this week we are in conversation with Ashish Gupta, CIO at Axis Mutual Fund, who's helping us figure out how we need to take a complete a view of our portfolios, look at our mutual fund investments, looking at the very dynamic market and the number of issues which it is grappling with. So one thing Ashish has already established is don't get carried away every time you hear a new tweet or a new, soundbite from the US. Stay focused on the medium to long term. So on that, Ashish, now I want to get to the heart of this. What we've seen with these GST reforms, with maybe the income tax cuts, is for the first time I've seen in the last, I think, maybe 7, 8, 9 years, that there is interest now in the consumer side of the market, mass consumption. But sure, is this a passing trend, just some sector rotation, or is this something more serious that we should take note of as investors?
So, I think consumption always has been the underpinning of India's growth story, right? So 60% of GDP, as you know, is driven by consumption. Even as you mentioned, in the last 7, 8 years, consumption as a theme may not have been very exciting, but there has been several pockets within that have provided a lot of growth opportunities, right? So, we have had pockets of discretionary consumption doing well. We have had changing consumption patterns benefiting us. We have had and I count stuff like real estate, hospitality, all part of the consumption basket. They have done very well over the last few years. You have had a new should I say, channels of consumption like quick commerce come to the fore. So I think as a broad theme, it might not have done well, but there have been pockets that have continued to do well, and I think that will stay true. I do believe that overall consumption expenditure growth that had slowed down to about 6-7% in the past 12 months is set for the pickup for the multiple reasons that we spoke about earlier. But within that, I think it's more important to focus on which are the new forms of consumption, which are the businesses and companies that are gaining market share, because that will drive returns. We have seen some early signs of broad-based consumption and GST cut announcements boosting the theme. So if you see in the last 6 months on the consumption side, we have seen the index go up nearly 13-14%. And it's also relative to where the valuations were, right? So many of these companies were trading at lower multiples compared to the kind of optimism that were there in other parts of market, including on the investment side. But again, on the investment side, equally, there are some themes that continue to be very strong, whether you look at, let's say, energy transition, right? So the renewable space or all the announcements around hydrogen. In fact, even more broadly, the power sector continues to be a very strong theme for us. It is there on the generation side as well as the transmission side. You also have continued capex happening towards all the EMS, OSAT. We are seeing actually increased capex even in many cement companies. Defense is another theme, if we can club in that bucket. So I think it's not that the capex side of story is seeing slowdown across the board. I think there are opportunities there that continue to be very attractive.
Okay, so it's not really either or, it's perhaps both as we look at a balanced portfolio over the medium term, consumer as well as investment or capex or the industrial side of the economy. Take that point, Ashish. Now, on consumer itself, and I don't know if you have data offhand, maybe you can shed some light on it, because the theme, and I'm talking mass consumption, I mean high-ticket consumption, like you said, like, you know, top dollar real estate companies or jewelry companies, they were anyway doing well. But I think mass consumer stocks were absent from most portfolios, or at least were in very little quantity, I guess, across the industry. So now, as you feel quite convinced about this consumption theme lasting, as an investor, should I just stick to diversified funds and eventually hope that, you know, my asset manager will eventually start buying these stocks if they're doing well? Or is it strong enough to warrant a thematic look? Should I be looking for consumption funds actually to look at playing it in a secular way over the next couple of years?
I think if you are looking on a 2-3 year view, I would say you stick to diversified funds. I think we have seen fund managers, I'm not just saying REMC, but if you see across the industry, they have been very good in terms of kind of generating consistently alpha across various market cap cohorts. So I think touchwood, the Indian portfolio management community has been able to catch the trends, have been able to differentiate among the companies that are going to benefit very decisively. So I would say stick to kind of diversified funds. I think investors who are looking at sectoral thematic funds, I think they have to take more tactical views, right? So those are, I think, 6 months, 1 year views. Otherwise, I think it's best to stick to diversified funds.
Okay, got that. That's really helpful. Now, Ashish, we're coming to the final few minutes of the conversation, so I have a request. You're a veteran of the financial markets and the financial services landscape in India, but for the next 1 minute, 60 seconds, if I could ask you to don the hat of an advisor, right? And I'm sure you get asked these questions to, you know, your friends and family. If you were to tell someone, you know, what kind of a mutual fund portfolio, this is a medium risk investor with at least a 3 or 5 year horizon, with that caveat in place. If you were to help someone design a portfolio, how much should be equity, gold? And gold is still booming. Every day we get asked the question saying, should we buy more silver funds or silver ETF or gold? And, then there is, of course, fixed income. Looking at the overall environment, the RBI, expectations of rate cuts. What would be your recipe for that portfolio? And which are the thematic categories that you would perhaps consider for this medium risk, medium term portfolio?
Sure. So I would say that I will still put kind of 65% of the portfolio in equities. I think between fixed income and REITs, and to the extent REITs get classified as equity now, either through the fund or directly, maybe another 10-15%, and 15% or so can be precious metals. I think take your pick between gold and silver. I think silver is outperforming for now. But I personally believe that if you are going for the kind of precious metal, it's kind of better to stick to gold. So if you are doing 15% there, I would say majority should be gold. Silver can be more tactical. And within equity, as I mentioned earlier, my preference is for the diversified funds. And rather than go for any market cap cohort, I would recommend doing a multi-cap or a flexi-cap fund. For thematic, rather than a narrow theme, do a broad theme like services or consumption. So even as I'm positive on, say, power sector or defense sector, I don't think it's appropriate for the medium-term investor to do a very narrow theme. You kind of play it through diversified funds, and for themes, you go for Broadway themes like consumption or services.
Oh, you've been so charitable. Thank you so much. It gives a great framework for our viewers to go back and reassess with their own advisors on how they can perhaps think about designing their portfolio. And I'm glad you brought up the point on REITs, Ashish. Actually, that's a cue for our viewers as well. We've done a REITs classroom earlier. We will revisit it because the regulation has changed. So let me just end with that, Ashish. Now, for the benefit of our viewers, SEBI is coming out with new rules, which means that equity mutual funds, wherever they're a little short on their equity allocation, they may want to add a bit of REITs as well, real estate investment trusts. Ashish, broad sort of view on this. What should we expect? Will more REITs get added to equity funds? Just what should we expect on this? Let's say a year down the line, as this is adopted.
I certainly think so. I think more should get added, and particularly, and as I said, where the multiples in the market are, we are not kind of expecting equity returns to be of the magnitude they were post-COVID, right? So from 2020, when the valuation levels at the market were very low, the returns have been very high. But from this level, if you expect market returns to be more in line with the nominal GDP, etc.,
which means 10%, Ashish? I have to try and pin you to a number, which means what, 10% CAGR equity returns?
So we hope nominal GDP growth recovers to a number higher than that, but it would be about 12-13%.
Oh, that's good.
Right. And so in that context, I think REITs offer a good stability. Yields are around 6-7% in terms of regular return, and with some potential upside of capital gains, right? So I think given that construct, I think REITs should form an increasing part of equity portfolios.
Okay, sounding absolutely great, and that's very reassuring. We can still work with 12-13% kind of compounding returns over longer periods in equities, and have perhaps a new asset class like REITs for added stability to the portfolio. Fantastic conversation, Ashish. Thank you so much. Extremely helpful for all of our viewers. Thank you very much for joining us on the show today.
Thank you, Surabhi.
All right. Well, there you have it, a review from Axis Mutual Fund. And with that, as a wrap on this edition, do let us know what you thought of the conversation. Send us your questions, anything new that you're interested in, and we'll take up those issues in the coming weeks. Thanks for watching.
Let's talk money.